This is Sarah Cage Richter, and I'm joined again by my co-host Adam Olsen, Embark's national quality leader. And we also have Julie Avellanet, a senior manager who is on Adam's quality team. They are here to give us the technical scoop on lessor considerations under ASC 842. And I feel like lessees get all of the attention when it comes to 842, and for good reason, but like the middle child in the family, sometimes the other kid needs some attention. So we're going to focus our conversation on lessors today. With that said, Adam, can you give a quick overview of lessor accounting under 842?
Yeah, sure. So, ASC 842 really did not make extensive changes to the existing lessor accounting, which I think is very helpful for most lessors. They're having to do less work. But there are a few things that definitely did change. But classifications are the same. They still have the three types of classifications. You got a sales type lease, you got direct financing, or an operating lease. And the accounting for operating sales type and direct financing leases are essentially the same. As far as lease income recognition and whether or not you do recognize the leased asset or not. None of that has really changed. Where they did make pointed improvements, I would say, in the lessor guidance, it was either to mirror the changes that were done for lessees. So whether it's defining certain lease concepts, maybe clarifying if there were some ambiguities in ASC 840, or also to align with the new revenue standard, ASC 606. We'll talk quite a bit today where there's areas where changes were done, and it was directly to help align with how accounting works under ASC 606.
So there's a lot of consistency for lessors, but what are some key areas that have changed that you could highlight for some lessors out there?
Yeah, I'm glad you asked. So we opened up with saying there haven't been a lot of changes, but there are 5 kind of key areas I do think of when it comes to lessor accounting where there are impacts under 842. So the first one's around lease classification, not specifically the types, but we'll get a bit more into that. Allocation of consideration in the contract, how that might work under 842. Accounting for initial direct costs, some changes around that. There's a lot of collectibility guidance that lessors need to be aware of under 842. So we'll talk at length about that. And then I think one of the biggest ones, especially if you are a lessor and you've been kind of following the FASB and what they're doing around this, but lease contracts with like extensive variable lease payments and how that impacts lessor accounting and some of the recent changes there. So I'm sure you're going to want to do a deep dive into all of these because I've been through this a few times with you, I would say.
Yep, this isn't your first rodeo. So let's start with your first point, which was lease classifications. We have the same types of classifications, the operating, sales type, and direct financing, but we go through different tests and thresholds now. They've kind of changed some of those. So could you talk through how that guidance is applied for lessors?
Yeah, so let's look at the classification test just to help maybe set the stage. So there's kind of 2 sets of tests that lessors apply. There's like the part 1 test, which is really determining whether or not the lease from a lessor perspective would qualify as a sales type lease. And these are very similar, shouldn't say very similar. They are the exact same test that lessee apply when they're trying to determine whether or not they have a finance lease or an operating lease. So you've got your transfer of ownership test, you've got your purchase option, lease term considerations, the lease payments test, as well as the, specialized asset test, kind of the newer test they added in there. So, lessors go through those same tests and evaluate them. If they meet any of those tests, the lease would qualify as a sales type lease. And those tests are really intended more or less because to end up with the result where you do have a sales type lease, because meeting any of those tests really is saying to a lessor that the lease contract was structured very similar economically to a sale itself. And so you really should account for it as a sales type lease. If none of those 5 tests are met, then you kind of go into this like part 2 kind of set of tests to figure out whether or not the lease would qualify as a direct financing lease. If it doesn't, then obviously, the catch-all is you end up in operating. But the direct financing lease criteria is really focusing there more so on credit risk and whether there's been kind of a transfer of the risk in the lease to credit risk. So if that is the case, you end up with a direct financing lease, and then obviously absent that, you're just left with operating lease accounting.
I think the saddest thing about this is that I remember studying for the CPA exam, and Tim Garrity had a great little acronym for this. And I trust that Tim has come up with a new one for these new.
No doubt.
Yeah. But that was so helpful for the test. I can't remember what it was, but it got me through the CPA exam.
That's important.
Okay, so we have our basis for classification under 842. Where could lessors see some changes or impacts to how they accounted for things previously?
Yeah, so the biggest one is kind of when you do your classification test. So this is true for lessees or lessors. So lease classification determination is at lease commencement under 842. Originally, it was done at lease inception. So that's kind of the overarching change. A couple other areas where there's been changes in maybe the way you apply some of those tests is the first one is around kind of the existence of manufacturer or dealer profit or loss. So historically, for a lease to qualify as a sales type lease, there had to be the presence of kind of manufacturer or dealer profit or loss. That is no longer required under ASC 842. That there has to be the presence of profit or loss at commencement in order for it to be a sales type lease. So that being said, you could also have, leases that don't meet any of those 5 classification tests that do have a bit of profit built into the contract that could qualify as a direct financing lease, which is kind of unusual if you think about the historical way we accounted for those leases before. The fair value of the underlying asset had to kind of equal the lease payments in order for it to be a direct financing lease. No longer the case. So there could be some differences in classification because of that alone. The other one is around collectibility uncertainties around minimum lease payments. So this is particularly true around sales type leases. So historically under ASC 840, if collectibility uncertainties existed, oftentimes people would classify those leases as lessors as operating leases. That is no longer a factor that gets applied. So lessors could essentially have leases that do have, collectibility issues, and there's, different guidance on how you handle that under 842. That would now be sales type leases where historically they may have been operating leases. And then the last couple I would probably, point out here, one is around real estate leases. So real estate leases under 840, kind of had very specific guidance. For example, in order to qualify as like a sales type lease, for a real estate lease to qualify as a sales type lease, I should say, there had to be kind of a transfer of ownership at the end. That was like, a catch-all that had to be there. That's no longer required. They basically just apply the same tests. There's no specific guidance directly just for real estate leases. They follow the same framework that we have for all other leases. And then the last one I'd close out is just leverage leases. So this was eliminated under ASC 842. So there's no concept of leverage leases for new leases under 842. But I will say if you have an existing leverage lease under 840, you are grandfathered in to continue to account for that lease as a leverage lease, post adoption. The only thing to keep in mind is if that lease was ever modified or changed after the adoption of 842, you would no longer be able to apply leverage lease guidance. So,
I have a bonus question.
Sure.
Does CECL play into the collectibility for sales type leases?
It does.
Okay, we have a CECL episode if you want to know more about that. I was just thinking about, you put that long-term receivable on your books, and so there has to be something with that collectibility to.
Yeah, and I know we'll touch on collectibility a bit more, but yeah, we'll get into a bit about, if you've got a lease receivable, what you need to think about as it relates to potentially any, collectibility issues.
It all works together. That's the beauty of accounting. What about expedients around classification? Do those work the same for the lessees at the transition date?
Yeah, they do. So, similar to like what lessees have, they've got that package. Obviously, if a reporting entity adopts the package, they have to apply it to all leases, whether they're a lessee or lessor. So, part of that package was you kind of carry forward that lease classification for existing leases. So whatever you had it classified under 840 would carry forward under 842. But obviously kind of keep in mind that new leases you enter into, you kind of have to go through this new, the guidance that we kind of just talked about as far as applying those classification tests.
Okay, so I think that covers our lease classification. Next on the list of key changes was the allocation of consideration in a lease.
Mhm.
Julie, what should lessors look out for here?
Yeah, so first I want to level set by saying that allocating the consideration in a lease is no different for lessees and lessors.
Mhm.
That's good. That being said, the first step would be to determine all of your lease and non-lease components that exist in the arrangement. And then you figure out how you're going to measure and allocate the consideration in the contract among the different components and account for them separately. Now, the process of allocating that consideration under 842 mirrors the transaction price allocation guidance under 606, which
Mhm.
is under the relative standalone price basis. Whereas under 840, it mirrored the multiple element guidance under 605. So, with these allocation methods, they can vary depending on the circumstances of the arrangement, especially when there's bundle discounts, variable consideration, and also the guidance under 606.
It sounds pretty complicated, and I know that there's
Yep.
an expedient for lessees that they can take when combining a lease and non-lease components, to simplify some of that accounting.
Yep.
Because, like I said, sounds very complicated. Do lessors get the same option?
They do. However, they can't necessarily apply it to all of their leases like a lessee can. They have to meet two conditions in order to combine their lease and non lease components. The first condition is that the timing and the pattern of transfer of the non lease component and the associated lease component must be the same. And also, the standalone lease component would be classified as an operating lease if it were accounted for separately.
Mhm.
So if you elect that practical expedient and you combine the non-lease component and the lease component, then how you account for that single combined component would depend on additional facts and circumstances. You'll want to consider, which component is actually more predominant in the arrangement. If the non-lease component is more predominant, then you would account for the whole combined component under 606, whereas if the lease component was more predominant, you would account for it under 842.
Okay, so you mentioned 2 conditions that need to be met, so
Yep.
let's look at each one of those. The first one you mentioned was the timing and pattern of transfer is the same.
Yep.
What does a lessor need to evaluate here to meet this condition?
So, two things here. A non lease component must meet one of the criteria under 606 to be satisfied over time rather than at a point in time.
Mhm.
And also, that non lease component must have a straight line pattern of transfer to the lessee. So, usually, this means that the component, or if you think about it in the context of 606, the performance obligation would be satisfied using a time elapsed measure of progress. The FASB actually said that even arrangements that include the sale of consumables with leased equipment couldn't apply this practical expedient if the consumables are transferred at a point in time versus over time, even in cases where the consumables will be used with the leased equipment over the entire lease term. So it's very important that they meet those two conditions.
Okay, so let's say that we've met condition number 1, and I believe that the second condition was about the standalone lease components. So how does an entity determine which component is the predominant one in the arrangement?
So everyone's favorite answer, it depends. It requires some judgment, which 842 allows for more judgment here. So there's no
Mhm.
quantitative test or threshold that's used to determine which component is more predominant. The FASB expects that most entities will be able to qualitatively determine which component is more predominant. So some things you could ask yourself as a lessor are, how does the customer view the arrangement? Is the non-lease component more significant than the
Mhm.
lease component in the customer's eyes? Another question to ask is, how are you as a lessor entity selling and marketing that arrangement? Another question is, what kind of costs are being incurred to
Mhm.
fulfill these components, and are more costs being incurred for one component over the other?
Makes sense. If a lessor elects the expedient to combine their components on qualifying leases and those leases have variable payments,
Yep.
how are those accounted for?
Yeah. So again, here it depends. It depends on which component is more predominant. If the non-lease component is more predominant, then all your variable payments, including any variable lease payments, would all be accounted for under 606. Whereas if the lease component was more predominant, then all your variable payments for the goods and services, including any variable lease payments, would all be considered variable lease payments under 842.
Makes sense. So it sounds like people need a good understanding of 606 and
Yeah, for
842.
sure.
So the third key change that Adam mentioned was initial direct costs. How is the accounting for these different for lessors?
Yeah, so 842 actually provides a more narrow definition of what an initial direct cost is, and this applies to both lessees and lessors the same. Under 842, initial direct costs only include those incremental costs that are incurred if the lease is obtained. Under 840, you could capitalize incremental direct costs to obtain a lease, even if they were incurred before the lease was obtained. So with this change in the definitions, some costs, so think like legal fees, your allocated internal costs like salary, all of those costs that an entity was able to capitalize as an initial direct cost under 840 will now be expensed as incurred under 842. For some lessors, this might result in recognizing more expenses before the lease even begins. And it'll also result in higher margins on those lease incomes over the lease term.
What was the rationale for narrowing that definition of initial direct costs under 842?
Yeah, so this again was intended to try and align the new lease standard with the new revenue standard. And so when 606 was rolled out, the FASB also updated the guidance for the related costs to obtain a contract in ASC 340. And 340 says that contract costs should only be recognized for incremental costs to obtain a contract that wouldn't have been incurred if the contract had not been obtained. So that's the same concept for initial direct costs under 842.
And you mentioned a few examples, but do you have any more examples of typical initial direct costs that we might see?
Yeah, so you want to think about, commissions that are incurred that are based on an incentive, not necessarily commissions that are just part of a salary, right? You also would think about regulatory or lease filing fees that are incurred after the lease has been executed, legal fees that are contingent only upon a successful lease being entered into. Think about lease termination fees for existing tenants. And another one would be, consideration that you pay to a third party for a residual value guarantee. All of those would only be incurred if a lease had been obtained.
And I know the answer to this one, but I'm going to go ahead and ask it anyways, because I like these. Any expedients here to help with the transition?
Fortunately, yes. Similar to the discussion that we had over classification, that package of practical expedients allows an entity to not reassess their initial direct costs. So this means that at transition for any existing leases, if you previously capitalized an initial direct cost, you don't have to reassess it to see if it meets that narrower definition of under 842.
We love those expedients. I think next on the list we had collectibility, and we previously touched on collectibility when we walked through the classification and how uncertainty there doesn't always result in an operating lease anymore for lessors. But Adam, how else does collectibility impact lessors under 842?
Yeah, so let's look at collectibility from the standpoint of once you know your classification, how it could then impact maybe the subsequent accounting for that lease. So let's take sales type leases to start. So if collectibility is not probable at lease commencement, you would not recognize any day one profit or loss. Instead, you would defer recognition of that sale until that collectibility becomes probable at a later point in time. So this is quite frankly going to require lessors where they have situations like this to continually monitor whether or not those leases become collectible at a later point in time. And this was purposeful. It's really intended to also, we've mentioned it mirrors 606 for this or that. This is another situation where they put this collectibility guidance in there to align with 606, and the FASB was purposeful for that because they didn't want people to try to structure contracts in a certain way where they could try to circumvent the collectibility guidance in 606 and make them sales type leases because sales type leases were more forgiving. So what they did is essentially said, no, we're going to have the same collectibility guidance. If it's not probable, you shouldn't recognize any income.
So how would they account for the sales type lease if they don't recognize the sale then?
Yeah, so if there's not a sale to record, the lessor is obviously not going to de-recognize the leased asset. So they're going to keep that on their books, continue to depreciate that asset. It would still be subject to ongoing impairment. So likewise, there's going to be no net investment in the lease. Any payments that the lessor might receive. So I know we said collectibility was not probable, but maybe the lessee is making some payments. Those are more or less just considered deposits, lessee deposits. So it's going to be some type of liability that's going to sit on your books, and they'll sit there for a while. It's either going to sit there until collectibility becomes probable, the lease terminates, and those payments are non-refundable, or if they are refundable, then they'll get sent back to the lessee. So it kind of just depends on the circumstances. If there are any initial direct costs associated with the lease, those typically are just going to be expensed, at the original lease commencement date. And the lessee would also not recognize any interest expense on that deposit liability. It's essentially just going to sit there.
I'm guessing it's not our risk-averse accounting friends who are entering into these collectibility day one
Okay.
type transactions. So what happens to the deposit liability if the lease receivable never becomes probable of being collected before that lease is terminated?
Yeah, so it's going to depend for sure on the circumstances. So let's say that there's lease payments that are non-refundable. So if the lessor, the lease terminates, the payments are non-refundable. At that point in time, the lessor could de-recognize that lease liability for those lessee deposits, and they would essentially just reverse that into income. This could also be the case if the lessor repossessed the leased asset. So they took it back and there was no further obligations under that lease. At that point in time, if there was still a lessee deposit liability on the lessor's books, they could also unwind that and recognize it into income. Like I said, if this is the case, that leased asset is still going to sit on their books. So like I said, they have to depreciate that asset. It's still continuing to be reviewed for impairment if necessary. It's just really like, what do we do with this liability account?
What happens if lease payments are probable of being collected at commencement, but subsequently there's a decline in creditworthiness or a global pandemic hits the world and the lessee might not be able to pay anymore, so those assumptions have changed?
Yep.
How does that work?
Yeah, so for all leases, a lessor does not reassess classification unless the lease is modified and the modification is not accounted for as a separate contract. So if there are changes in collectibility after lease commencement, it's not going to impact classification. So classification has already been set. So, I guess an example here would be that if you have a lease that's classified as an operating lease at commencement solely because it's not considered collectible, whereas if it was collectible, it would be a direct financing lease. If that lease down the road all of a sudden becomes probable of being collectible, you wouldn't change the classification of that lease to a direct financing lease. It's still an operating lease. You would then apply the collectibility guidance for operating leases to figure out how you would account for that change in collectibility. So that's important to kind of keep in mind, is that it doesn't impact classification for any of the lease accounting itself. And like I said, if collectibility is probable at the commencement date for a sales type lease, the lessor doesn't have to reassess if that collectibility changes. It's only if that collectibility is not certain at the commencement date would a lessor have to continually monitor it. Instead, what happens if collectibility shifts after the sales type or after commencement of the sales type lease? It really becomes kind of what you were alluding to here with CECL, or if you haven't adopted CECL, kind of that incurred loss model. But whether or not there needs to be some type of reserve or whatever for those lease receivables because of that change in collectibility.
I jumped the gun earlier on CECL. Well, that's a great segue. We mentioned operating leases a few times there. So are lessors operating leases impacted by collectibility?
They are. So a lessor's pattern of recognition of lease income could be impacted by collectibility. So let's just start with the easiest one. So if collectibility is probable at commencement, everything's hunky dory. So it's just like you recognize lease income generally on a straight line pattern over the lease term, no issues there.
Right.
However, if collectibility is not probable, then the lease income that a lessor can recognize is going to be limited. And so there's a limit that's based on the lessor of two things. So it's either the income that would have been recognized if collectibility was probable, or it would just be the actual cash like lease payments received. So it's almost like a cash basis way of viewing it. So you look at which of those two would be the lesser, and that's your cap as far as what you can recognize for lease income. And so that being said, is that we mentioned that for sales type leases that a lessor only has to monitor collectibility if it's not probable at commencement. If it is probable at commencement, they don't have to worry about changes in collectibility after the fact. It only impacts the reserves. It's different for operating leases. So whether or not it's probable or not probable at commencement, lessors do have to monitor ongoing collectibility, because if there ever is a change, then that cap could come into play.
Mhm. All right. So on that note, what happens if there is a change in collectibility over the lease term from lease commencement?
Yeah, so let's look at it kind of twofold here. So if it is no longer probable, the collectibility, so the lease all of a sudden becomes troubled, and the cumulative cash receipts that have been received on the lease are less than the income that's been recognized to date, then that excess income would have to be reversed. On the flip side, if collectibility changes back to probable, let's say things improve down the road, then any difference between the lease income that would have been recognized if collectibility had always been probable, and the actual lease income that's been recognized to date as current period lease income would be, recognized in the contract itself. Probability in the context is this has, obviously based on the credit standing of the lessee. So a couple things here to keep in mind is if there are just general disputes about maybe variable lease payments or things of that nature, that shouldn't impact a lessor's like determination of whether or not something's probable of being collectible or not.
That makes sense. And it's usually straight line that causes that difference between cash receipts and recognized revenue. Because
Right.
that seems like such an odd concept that you would have recognized more revenue than you received. But I think that's that straight line that is really hard to understand until you see it.
Yeah,
in
so for sure,
practice.
a lot of leases have those like escalating
Mhm.
payments, or just,
Mhm.
payments are all over the place on different years or different periods. And so, under GAAP, obviously for operating leases, you still have to recognize income on a straight line basis in most cases.
And I'm getting excited because variable lease payments is coming up. I'm jumping the gun. What about operating lease receivables? Are reserves still appropriate for those, as was the case under ASC 840?
Yeah, so ASC 842 really doesn't go into the guidance on how to like apply valuation of operating lease receivables. Instead, for a lot of people, ASC 310, which was kind of the original like incurred loss receivables standard itself, indicated that if you had something that was not in the scope of other topics, then you could turn to the contingency guidance in ASC 450. And this would even be the case for those that have adopted CECL, because operating lease receivables are not in the scope of CECL either. It's only sales type receivables there that are in scope. So this would also be the case there. So ultimately, what the FASB said is that if you still want to create some type of like general reserve for your operating lease receivables, that would still be okay. It would need to be some type of accounting policy election that the entity would make, and then obviously you disclose that. And that would be recorded either as a reduction of revenue or as bad debt expense, depending on your policy. But there still is, I guess, permissibility that you could have some type of general reserve if you feel it's necessary.
So is it fair to say that collectibility issues under 842 are more problematic than under 840?
Yeah, they are. I would say they're definitely problematic and more punitive for sure, because they do kind of delay recognition of lease income, which doesn't seem like that revolutionary of a concept. But yeah, compared to the old leasing guidance, for sure, it's definitely more punitive under 842.
Okay, so now the question I was trying to get to earlier, number 5 on the list, variable lease payments. I know leases often have variable lease payments included in arrangements, like rent bumps and stuff like that. So how can these impact lessors?
Yeah, this has been a hot topic for lessors for a while, really since the standard kind of came out. Just some issues that they were raising early on with the way the guidance was written. But I think maybe
Mhm.
to help illustrate this, it'd be helpful just to back up and remind people exactly what is a variable lease payment and how those are accounted for under 842. So the guidance in 842 does constitute what actually qualifies as a lease payment. And variable lease payments that are not based on an index or a rate are excluded from what is considered a lease payment.
Mhm.
And so, people are asking, maybe why does that matter? It's particularly relevant in cases where you do have certain sales type leases. And again, sales type leases are the ones where day one you're going to recognize that profit or loss.
Mhm.
And either a large portion of the contract or maybe entirely all the lease payments in the contract are variable. Under the 842 guidance and definition of a lease payments, those don't, any variable lease payments do not get included in that. So there were situations where there were large variable lease payments in a contract that were causing large day one losses
Mm.
for sales type leases. And so that became problematic, I think, for a lot of lessors to wrap their head around. They were just like, economically, this doesn't really make sense
Yeah.
because we know the lease is going to be profitable over the the contract
different.
term. Otherwise, we would not be entering into these things. But the way the standard was originally written was obviously giving that consequence where there was a large day one loss.
So, didn't the FASB have a project on their technical agenda to continue to look at this? And have they made any progress here?
They did, yeah. So this has been, like I said, to no surprise, lessors raised this up as an issue.
Yeah.
So there was a lot of feedback, obviously, about how the accounting was working here, and that, like I said, like the outcomes of those lease arrangements didn't reflect the true economics of those leases,
Mhm.
and
Yeah.
so it would technically also like inflate margins later on when you start recognizing all these variable lease payments coming in. And so, there was like pushback on the FASB, hey, you guys need to look at this. So the FASB did take this issue rather and add it to their technical agenda. It kind of went through obviously all the standard process that they go through when they're looking to potentially issue a new standard. And so they actually did just recently issue an updated standard. So it's ASU 2021-05 was recently issued to address this specific issue where you do have significant variable payments in a sales type lease that do cause a day one loss. And so what that ASU basically states is that if you have a lease that there are predominantly variable payments and it would cause a loss, those leases should be classified as operating leases. And they would no longer be classified as a sales type lease. So you would account for it very similar to how you account for other operating leases. So variable lease revenue earned and would be recognized, over the lease term. You wouldn't de-recognize the leased asset like you would in a sales type lease. You would continue to depreciate that asset and account for it, under the normal guidance in 360. So definitely welcomed relief there for sure.
Yeah. Sounds like it takes some of that volatility out. Um, let's round out our discussion focusing on the reporting side of things. I know lessees have a significant increase in their disclosures under 842. Julie, what about from a lessor perspective?
Yeah, so lessors also had an increased amount of required disclosures.
Mm.
So if you think about the primary intent of ASC 842 was to provide users of the financial statements with more information.
Mm-hmm.
Specifically for the lessors, their incremental disclosures was intended to provide more information about their risk
Mm-hmm.
that they're exposed to in leases, such as credit risk, to provide more information about their residual interest in their leased assets, as well as provide more information about their income from leases.
So, what are some of the disclosures that lessors have to make?
Yeah, so we'll break this up between qualitative and quantitative disclosures. And as we just said, there's more disclosures. So I actually have this written down in my notes here. So from a qualitative perspective, lessors need to disclose any significant accounting judgments and estimates that they used in leases. They would also disclose information about the nature of the leases themselves. So think about, what's the nature of the variable payment arrangements? Do you have any termination options, renewal options, purchase options? uh, Also, do you have any information about how the lessor manages their residual asset risk, including information about any residual value guarantees and other means of limiting that risk? So if you jump over to quantitative disclosures, lessors need to disclose a maturity analysis of any lease receivables if they have sales type and direct financing leases. And if they have any operating leases, they would disclose a maturity analysis of lease payments for said operating leases. If they had any operating lease income, they would disclose that, any variable lease income, as well as any selling profit or loss that's recognized at lease commencement and interest income for sales type and direct financing leases.
So that's a lot for them to disclose.
It's quite a bit.
Do you guys have any final thoughts that you want to leave our listeners with?
So as we've talked about, lessors don't have as many significant changes under 842 as lessees do. However, not everything's the same. So lessors should still take the time to look through their systems, their processes, internal controls, see what needs to change in order to help them to comply with all the lessor requirements for 842, including the disclosures we just walked through.
Yeah, and I would just add, it's one area we didn't necessarily touch on, but just lease modifications, kind of in general. So just at a high level, like for those that are familiar with the lessee guidance, the lessor modification guidance does not mirror the lessee modification guidance under 842, but it really was designed to align again here with kind of contract modification guidance that you would see under 606, which basically, you account for those modifications prospectively. And this is welcome change, I think, because the previous guidance under 840 for modifications for lessors was a little bit hairy, and a lot of people will get a little bit lost in the complexities there. So hopefully this helps align people with the concept that they're already familiar with in 606. But I really only mention this too because we touched on one area where the FASB's provided relief related to variable lease payments, but there's also another project on their technical agenda related to lease modifications. And it's actually them looking more holistically now at lease modification framework in 842. And so what will come of that, what they'll do with it, what are those changes, if any, will be lessee, lessor, or both, time will tell. But I think it just helps illustrate is that there's been a lot of changes in the standard since the original standard was issued, and a lot of it's in response to feedback, roundtables that have been held by the FASB, just soliciting from preparers and the like, hey, where are there areas that we can make targeted improvements to the standard itself? And this is another area where that is the case. So if you operate a lot in the lease space, just, for sure keep an eye on what the FASB is doing, because I think there's going to continue to be changes, and for the good changes to help, drive home the intent of the new lease standard.
All right. Well, I think that's a great place for us to stop today. And I think some words of wisdom for all of our lessors out there based on all those changes that are coming. Check the date of what you are referring to. Don't just think you have the most updated piece of guidance or blog posts or all those things. So we would love to connect with you if you have any questions or want to know more about today's discussion. There are links to all of Embark's social media platforms in the show notes, and you can reach out to us with questions on the platform of your choosing. Thanks, Julie, for braving the microphone and joining Adam and I today. And thank you, listeners, for following along on another episode of Accounting Matters.